April 4th, 2025 is today's date. We're going to be going over some safe options for your money in this time of uncertainty during Trump's tariffs. I encourage you, if you're looking for peace of mind, to opt out of the uncertainty, to watch till the end. My name is Daniel McCluskey. Last year we got 1.3 million into these strategies, in which none of those clients, myself included, have lost a dime due to the markets going down. Those two strategies we're going to go in depth in at the end. So I encourage you to make sure you watch all the way through. First, we're going to touch on the markets. We're going to review those very quickly. We're going to go over, I'm going to give a little disclaimer. I'm not saying that the world is over, and perhaps that these strategies would even return higher than just keeping your money in the market. We are just going to look at the data, the numbers, be very unbiased in this situation, go over some basic economic principles to remember during this time, and then Trump's plan here with the tariffs, as well as a couple comments we're going to show here from JD Vance, and we'll get into the strategy of indexing. So first, the markets. I want to turn to my screen here. S&P 500, it's currently a little past 2 p.m. Eastern, is down 4.79% today. Yesterday, comparable number. The last 5 days, over 8%, almost 10% on $1 million portfolio. That's down $100,000. The Dow Jones is down 3.74%. The Russell, 4.6%. The NASDAQ, 4.71%. Volatility, the VIX index, tracking the volatility of the market, in the last year is as high as it's been. If this would load here, and then we'll see in a second, over the last 5 years, the volatility index, so this is the past year, higher than August of 2024 when we had a market spike, and in the last 5 years, barely down from where we were, almost at its highest all-time. Not quite as high as 2020 with the COVID crash, not quite as high as 2008, about a little more than halfway there, about 2/3 of the way there to be more specific when it comes to volatility. The S&P 500, however, I want to point out year to date might be down 13%. However, over the course of the last year, just about break even, minus 0.18%, as you can see there on my screen. Over the past 5 years, it's done pretty dang well, over 100%. That's more than doubling in 5 years, so pretty good there. And all time, what you'll notice if you look at the early crash here in the 2000s, the early 2000s, 2008 here on my screen, this looks worse. It looks a lot bigger. The reason it's not is because the amount of points that the S&P 500 was at that time was lower. So percentage-wise, this might have been a 40% drop in 2008. That's because there only was so many points that the S&P 500 had. Up here, we are now well above 5,000. It was not long ago we were above 6,100. Now we're down to 5,100, 5,138, as you can see there. So a little disclaimer and thing I want to point out is that in the business I'm in, this sort of event, frankly, for me, helps me. It helps my marketing. It helps my business. It helps me to, in the strategies that I use, being able to relink and wait for the market to come back and earn while that's happening. However, even though that does help me out, and especially with people who are stressed out, who want peace of mind, encourages them to maybe move their money towards a safer strategy, especially as they get closer to retirement. Maybe they're already in retirement, preparing for making sure that they don't have to go back to work, whatever that is. There is, in a recent book that I'm reading, Economics in One Lesson by Henry Hazlitt, there's two main errors with more modern economists that we need to keep in mind. Number one, I'm going to read the quote here. He says it can be reduced to a single sentence. The art of economics consists in looking not merely at the immediate, but at the longer effects of any act or any policy. It consists in tracing the consequences of that policy, not merely for one group, but of all groups. So first thing is the more modern economists are more so just looking at the short-term effects of any sort of policy and convincing the general public not to be concerned about or worry about the long-term effects, but just what's happening now. And the second big error is focusing on how this impacts just one group instead of all groups. There's also the error the other way. The more classical economists we're looking at just the very long term and not thinking about the short term, because in the end, we are dealing with Americans. We are all human beings, and even if there are very detrimental short-term ramifications of a certain plan that is going to work out very long term, that's going to make a lot of people nervous. So we have to consider both sides there. That's the first thing, especially Trump's plan with the tariffs. He is expecting, of course, and we'll kind of look at a little comment here from JD Vance in a second, but he's expecting the short-term kind of market chaos, consumer pressure. This has kind of been preached that he was going to do this even before he got into office. However, the goal is, of course, to create more jobs in the United States, and this short-term pressure will hopefully turn into an economic boom. Of course, that is the plan of Trump. Now, he clearly understands that first policy, or at least is preaching that first policy of not just the short-term ramifications. Two quotes, one from JD Vance here from an interview this morning describing the current economic situation and why change was needed. We'll look at that here.
That other countries make for us. And to make it a little bit more crystal clear, we borrow money from Chinese peasants to buy the things those Chinese peasants manufacture. That is not a recipe for economic prosperity. It's not a recipe for low prices, and it's not a recipe for good jobs in the United States of America. For 40 years, we have gone down that pathway. We've seen closing factories. We've seen rising inflation. We've seen the cost of housing so high that most Americans can't afford to buy a home right now. President Trump is taking this economy in a different direction. He ran on that, he promised it, and now he's delivering. And yes, this is a big change. I'm not going to shy away from it, but we needed a big change, Lawrence. We cannot keep going.
We needed a big change is the final words there again from JD Vance. They, of course, understand that this is going to cause consumer pressure. And again, I want to put a little pin here and another point where he made commenting on that.
Just in the 2 months of the Trump administration. What I'd ask folks to appreciate here is that we are not going to fix things overnight. Joe Biden left us, this is not an exaggeration, Lawrence, with the largest peacetime debt deficit in the history of the United States of America, with sky-high interest rates. You don't fix that stuff overnight. We know people are struggling. We're fighting as quickly as we can to fix what was left to us, but it's not going to happen immediately. But we really do believe that if we pursue the right deregulation, we pursue those energy cost-reducing policies, yes, people are going to see it in their pocketbook. They're also going to benefit from the fact that foreign countries can't take advantage of us anymore. That means their jobs are going to be more secure.
I don't think you can talk about.
So there, again, JD Vance commenting on this is a long-term play. He believes that long-term consumers are going to see the benefits, and that along with that, markets are likely, in the view of President Trump and Vice President JD Vance, to come back and to boom. With that said, the reason for the disclaimer is that although, as I had mentioned there before, that this sort of market crisis does benefit me, especially in terms of marketing material, it also is only fair and important to point out the long-term ramifications that the politicians are aiming for with this tariff situation, and also to point out the history of the S&P 500 tending to come back. That's generally not why people are moving into the strategies that I'm about to display. It's more so for peace of mind, especially as you get closer to retirement, and even those who are retired just wanting safety, security, instead of keeping money in the stock market, being subject to market volatility as we're experiencing currently, and instead of looking for the highest possible rate of return, instead just guaranteeing their retirement, not having to go back to work, not having to reduce their lifestyle, and optimizing more so for their peace of mind rather than the highest possible return. So with all of that there, hopefully you'll realize the view that is healthy for someone to take looking into products like the strategies we'll go over now. That is going to be called indexing. Indexing is not indexed mutual funds, but rather it is a strategy that allows you to participate when the market performs well, but skip out when the market goes down. So we're going to pull up a little drawing board here and get into it. So indexing, which again is not indexed mutual funds. So first we're just going to go over the strategy from a high level, how it works, and then we're going to get into two different vehicles that you could move your money into that employ this very strategy to make sure you can miss out on currently what's going on. So that is, you have your money in an area that is getting credited interest. That interest buys what are called call options in the vehicles that we're going to go over. Automate all of this. You just get to select which indexes you link to, and then you are credited a gain, and the process from there is going to repeat. The whole idea here is you are only buying these call options with interest. So with interest only. The idea is if this works out, you make a gain, you're happy. If it does not work out, the only money that you lose is the interest that your money got credited, so your principal is still safe. For example, if you had a $100,000 in an account, you got 4% interest, let's say, so that's $4,000. If you only use that $4,000 to buy options, even if those options went to zero, you still have your $100,000 sitting in a place that was getting credited interest. That's the first step there. Just how, for example, banks are able to credit us 1% interest or any high yield savings, 4%, let's say, that is because they are taking our money, investing it, earning a higher rate of return, let's say 5, therefore they can credit us 4 and still operate with a profit. That's how banks function. That's how insurance companies function, on top of also being profitable just with the types of products they actually offer using actuarial tables to make sure they're profitable there long term. Insurance companies do the same thing. So that's how we're getting credited interest. That's step one, is to have your money there in a spot that's getting interest. Second is to use that interest, so that 4%, or we'll call it 4,000, as we'd said there before, to buy call options on an index. And how that works is essentially, let's explain options here first for those who aren't familiar. That's supposed to be a home. You gotta trust me. Let's say this home was worth $100,000. What I can do, or when I buy an option, is essentially, let's say the cost of that option was $4,000. That allows me to be able to decide if I want to purchase this home a year from today at the price it is today. So regardless of what happens with the value of the home, I can decide if I want to purchase it for $100,000. Same thing happens with the market. We'll get into that in a second. But let's say the home goes up in value to $110,000. Well, I have the option to buy it for $100,000. Would I buy it for $100,000 or $110,000? Of course, I'm going to buy it for the cheaper amount. So in that case, I just bought this home for $100,000. However, it's worth $110,000. So if I went to go sell it right away, I'd make a $10,000 profit. So in this case, I just made a 10% gain without ever risking my principal. Now here is where we protect against what's happening currently. Let's say the home went down in value to $80,000. I have the option to buy the home for $100,000. Am I going to buy it for $100,000 when I could buy it for $80,000? Of course, I'm not going to do that. Now that doesn't mean I have to buy it for $80,000. I don't have to exercise that option at all. But the point is, if I had just bought the home ahead of time and let it ride out, I would have lost $20,000. In this case, the home went down $20,000, 20%, and I didn't lose a dime because of that. The same thing works for the stock market. So the S&P 500, for example, I'm going to use my own personal policy as an example. On December the 15th, 2024, any gains from the previous year were locked in, and money that I had in my policy linked to the index at 6,074. Now, a year from today, if the S&P 500 is lower than that, currently it's at about 5,100. Since I linked my money to the index, it's down quite a lot. If the S&P 500 stays below that number, let's say, worst case scenario, just to make the example clear, the S&P 500 on 15/2025 is 3,000. Absolute worst case scenario, just for the example. I have the option to buy the S&P 500 for 6,074, even though it's worth 3,000. Am I going to do that? Of course I'm not. I'm not going to do that at all. And then what I'm going to do is I am going to buy options again. So I'm going to repeat the cycle on the 3,000. And that means a year from that day, I can decide if I want to buy the S&P 500 for 3,000. So what happens if I did an uncapped strategy, for example, and the S&P 500 goes back 12, 15, 26 to 6,000? Well, if I did an uncapped strategy, usually there's a spread charge. I won't get too into that in this specific video. But since I linked at the low point and it came all the way back, and again, these numbers are exaggerated for the example's sake, but I would make a 100% gain minus the spread charge. We're right back where we started, 6,074 back to 6,000, but I made a gain. That's the point. Again, the 100% is just an example to exaggerate it. But the point is when the market goes down, I'm able to lock in my gains from the previous year. And when the market goes back up, I participate in that 1 year time horizon, that point to point where it started and where it ended. I get, if it's up, I get whatever it's up. If it's down, I don't lose because of that, because I don't have to exercise that option. Usually there's going to be a cap rate on the upside, meaning if the market goes up 20% and I have a cap of 10, well, I'm only going to get 10%. I'm not going to get the full 20. However, there are uncapped strategies, for example, where you get whatever the market does minus, say, 7.5%. So if the market did 100, I'd get 92.5. Now again, 100%, just an example. The point is, with the strategy, when the market goes down, I don't lose a dime because of that. When the market goes up, I'm able to participate. Over the long haul, again, I pointed out that example is like that for this very specific reason. Is this going to outperform the market? Likely not. That's not really the reason people are doing the strategy of indexing. It's more so just for the peace of mind. Now, from there, you would get credited again and repeat over and over again. If that was a little confusing, think of it like a ratchet wrench. When you turn the wrench to the right, the bolt's going to get tighter. For example, when the market goes up, you're going to make gains. When you turn it back to the left or counterclockwise, it is just preparing to turn back to the right or go clockwise again, make the bolt tighter. So when the market goes down, you don't lose because of that. You're staying exactly where you were. When it goes back to the right, you are going to go up with the market. That's the strategy, the two vehicles that you can implement this strategy in. Number one, the simplest way to do this are in fixed indexed annuities. That I there is key. That's what the indexed is for. You can use these for growing your money. You can use these to guarantee your retirement income forever. Income annuities are currently paying as high as they have in over 15 years. Fixed indexed annuity sales are up over 100% in the past 3 years because of this very reason, people wanting to opt out of market volatility. You can use it for income, you can use it for growth, you can use it for a mixture of both of those. The whole idea is protecting your retirement, guaranteeing that's going to be there forever. You don't have to lose because of market volatility. The second is going to be indexed, that I there, universal life. This takes longer to fund. The money, though, is going to grow tax-free. This is a strategy a lot of banks use, a lot of wealthy people use, cash value life insurance, to protect themselves from market downturns, make steady returns, have it be tax-free because it is life insurance. It's much more complicated than the fixed indexed annuity just in terms of setup and strategy. We won't get specifically into those too much today. However, the indexing is the strategy. These are the two vehicles that you can automate them in. Fixed index annuities are one-to-one. You can roll a 401k or an IRA directly over into one. Have peace of mind, be opted out of that for the rest of your life. Indexed universal life would be a roll out and in because it has to be post-tax dollars that go into indexed universal life, or if you have a Roth where it's just out and in, or money that's just already post-tax, you've already paid taxes on it, that's money that can also fund that strategy. Hopefully, this video was helpful. It'll be interesting to see how the tariff situation plays out. Again, this is not saying that the market isn't going to outperform these vehicles. It's not about that. It's more so just for peace of mind. If you are looking to bring peace to your finances, opt out of market volatility, and optimize for your life, your headspace, as opposed to the highest possible rate of return, I encourage you to request a contact from me down below. I'd be more than happy to help out. There's a little link there. First link in the description, McCluskeyFinancial.com/contact. Click that, submit your info. I'd be happy to help out. If you enjoyed the video, like, subscribe, and again, if you're looking for that peace of mind, click that top link in the description. I will see you in a future video. Bye-bye.